Welcome to the deep dive.
Yeah.
Ever wondered what actually happens when a business partnership changes hands?
Yeah, it sounds kind of niche, doesn't it?
It does.
Yeah.
But the financial mechanics behind partner exits, well, they impact so many people. Maybe you're in a business, maybe you're just curious.
Exactly.
So today we're taking a deep dive into partnership liquidation.
Mhm.
We're looking at the financial journey when a partner leaves or sells their share, or maybe the whole partnership just wraps up.
Right.
Our mission, to really pull out the crucial insights. So you're not just informed, but you actually get what's going on in this often pretty complex area.
And what's really fascinating, I think, is how these seemingly small choices, like how you structure the handling of that partnership interest, can have these massive tax and financial ripple effects for everyone involved.
Okay.
So we're going to pull back the curtain a bit on those mechanisms and really show you why paying attention to the details can make or break an exit strategy.
Okay, let's start by mapping things out. There seem to be three main ways, three pathways a partner can liquidate their interest.
Kind of like a choose your own adventure. Yeah.
Exactly, each with a different financial destination. So first, there's a complete withdrawal, sometimes called a liquidating distribution.
Mm-hmm.
Second, a partner might just sell their interest directly to someone new.
Pretty common.
And third, there's retirement, or, the unfortunate event of a partner passing away.
And while all three mean the partner's out, the tax and financial treatments, well, they diverge pretty dramatically.
Oh, okay.
And understanding that distinction is absolutely fundamental for the partner leaving, for the partner staying, and for the partnership itself.
Got it. So let's unpack that first path then, a complete withdrawal. This is where a partner just takes their share of assets and, well, leaves.
Right. And the cornerstone of this whole process, the really key thing, is figuring out the basis for any property the partner receives.
Basis. Okay, refresh this quickly.
Think of basis as your tax cost for an asset. Basically, what the IRS considers you to have paid for it.
Okay.
In a liquidating distribution, your basis in the property you get is generally your adjusted basis in your partnership interest. That's your investment, plus or minus profits, losses, liabilities. But, and this is important, reduced by any cash you receive.
Okay, reduced by cash.
And you need to calculate that adjusted basis right before the distribution happens. You have to account for all the current year's income, losses, changes in liabilities, everything up to that point.
That sounds critical. So is this type of withdrawal usually tax-free? Or do partners often end up recognizing a gain or loss right away?
Generally, the idea is for it to be non-taxable. The partner kind of carries over their basis into the new assets.
Right.
However,
There's always a however.
there usually is.
Yeah.
You will recognize a gain, typically a capital gain,
Yeah.
if the cash you receive is more than your adjusted basis in the partnership interest.
Just the cash.
Just the cash triggering the gain. And here's where it gets a bit more nuanced. You'll recognize a capital loss only if you receive solely cash, unrealized receivables, or inventory, and your partnership basis is more than the partnership's basis in those specific assets you got.
Okay, that's specific. Let's make this concrete. Let's imagine Tag, a partner in KJT. His adjusted basis in his partnership interest is, say, $24,000.
Okay, classic scenario. Let's say Tag takes $5,000 in cash plus some real estate. The real estate is worth $20,000, fair market value, but the partnership's basis in it was only $10,000.
Okay.
For Tag, his new basis in that real estate becomes $19,000. That's his $24,000 partnership basis minus the $5,000 cash he received.
Oh, okay. So no gain, no loss recognized immediately.
Exactly. His old partnership basis just sort of transfers to the new asset minus the cash part. That's the typical non-taxable outcome we mentioned.
But what if Tag got a bit more cash?
Yeah.
Say $25,000 in cash plus that same real estate. That changes things quite a bit, right?
Oh, absolutely. In that case, Tag would recognize a $1,000 capital gain right away. Because the $25,000 cash he received is more than his $24,000 original partnership basis, that extra $1,000 immediate taxable gain.
Wow. And the real estate.
And because his cash payout already soaked up and even exceeded his basis, the real estate he received in that specific situation would get a zero basis in his hands.
Zero basis. Ouch.
Yeah, it's a powerful example of how just a little extra cash can suddenly trigger a gain.
So cash is clearly a major factor. What if Tag got, say, $20,000 in cash and nothing else, no other assets?
Okay, different situation again. Tag would actually recognize a $4,000 capital loss.
A loss, even though he got cash.
Yep. His $24,000 partnership basis minus the $20,000 cash leaves $4,000 of basis sort of stranded. Since there are no other assets distributed to allocate that remaining basis to, it's recognized immediately as a loss.
Huh. That's interesting. It really forces you to think about your basis and what assets you're getting, not just the cash.
Exactly. It's not always intuitive.
Okay, one last alternative for Tag. What if, instead of that real estate, he received $5,000 cash plus? You mentioned hot assets, say unrealized receivables or inventory with a $10,000 basis to the partnership. How does that change things?
Right, the hot assets. These are things like unrealized receivables, basically. Income the partnership earned but hasn't collected or reported yet, common for cash basis folks, and inventory, obviously property held for sale.
Why are they hot?
They're treated specially because if the partnership had sold them directly, the gain would likely be ordinary income, not capital gain. The rules try to prevent partners from converting that potential ordinary income into capital gain just by taking the asset out in liquidation.
Got it. So back to Tag.
If Tag received 5 Cal-K cash and these hot assets with a $10 partnership basis, he'd actually recognize a $9,000 capital loss.
How's that calculated?
It's his $24,000 basis minus the $5,000 cash and minus the $10,000 basis of the hot assets he received.
And his basis in those hot assets.
It would just carry over at $10,000, the same as the partnership's basis. It preserves that potential ordinary income character.
Okay, so we've covered cash, maybe one other asset. But what if it's more complicated? A partner gets a mixed cash, inventory, maybe different pieces of land or equipment. How do you allocate that remaining basis then?
Yeah, that's where it gets pretty intricate. There's a specific pecking order, a priority rule.
An order.
Yes. First, basis goes to cash. Then to those hot assets, inventory, and unrealized receivables. And finally, whatever basis is left gets assigned to other property, like land or equipment.
Okay, cash, hot assets, other property. What if there are multiple assets within, say, the other property category?
Right. If you have multiple assets in either the hot asset or other property categories, you then follow a detailed 3-step process, and the exact steps depend on a key comparison.
Which is?
Whether the partner's basis in their partnership interest, we call that their outside basis, is less than or more than the partnership's total basis in the distributed assets, the inside basis.
Outside basis versus inside basis. Okay,
Right.
So what does this actually mean for, someone trying to figure out the value of the assets they just got? Let's take the first case. Your outside basis is less than the partnership's inside basis in the assets you're getting.
Right. In that situation, the goal essentially is that your new basis in the property you received gets reduced so it matches your initial investment, your outside basis. Your partnership interest has to end up at 0.
So the process aims to bring that basis down. How?
Okay, 3 steps when outside basis is less than inside basis.
You start by tentatively assigning a basis to all the assets you received, equal to whatever the partnership's basis was in those assets.
Just copy the partnership's numbers initially.
Exactly. Step 2. Then you look at the last property category distributed, usually other property unless only hot assets were distributed after cash. You find any assets in that category that have decreased in value, their fair market value is less than their basis, and you reduce their basis down to their fair market value.
Why do that?
It prevents you from getting an artificially high basis in an asset that's already lost value.
Okay, step 3.
Step 3. You figure out how much more reduction is needed to make the total basis equal your outside basis. You allocate that remaining reduction among all the assets in that last property category proportionally based on their adjusted basis after step 2. It's relative allocation.
Wow. Okay, let's try this with Gertie. His partnership basis, his outside basis, is $229,000. He gets $4,000 cash, $10,000 inventory. Then Landlot A, which had a $200,000 basis to the partnership but is only worth $150,000 now, and Landlot B, with a $100,000 partnership basis but worth $300,000.
Okay, first check the comparison. Gordon's outside basis is $229K. The partnership's inside basis in all those assets totals $314K, $4K plus $10K plus $200K plus $100K.
So outside is less than inside. We need to reduce.
Correct. The total reduction needed is $314K minus $229K, which is $85,000.
Okay, now the steps.
Step 1. Apply basis first to cash, 4K, and inventory 10K. That uses 14K of Garrity's 229K basis, leaving 215K for the other property, the 2 lots.
Right.
Step 2. Look at the other property, lots A and B. Lot A has depreciated, 200K basis, 150K FMV. So we reduced Lot A's basis by $50,000 down to its 150K fair market value. Lot B appreciated, so no downward adjustment there yet. This uses 50K of our needed 85K reduction.
Leaving $35,000 of reduction still to allocate.
Exactly. Step 3. Allocate that remaining $35,000 decrease between Lot A and Lot B based on their adjusted bases after Step 2. Lot A is now at 150K, Lot B is still at its initial 100K from Step 1, total 250K.
So the math.
Lot A gets a further reduction of $21,000, which is 152 times 35K. Lot B gets reduced by $14,000, 120 times 35K.
So Geardy's final bases are?
Cash $4,000. Inventory $10,000. Lot A is $129,000, 150K from Step 2 minus the 21K from Step 3. And Lot B is $86,000, 100K from Step 1 minus the $14K from Step 3.
And if you add those up, $4K plus $10 plus $129K plus $86K.
It equals $229,000. Exactly. Gertie's original outside basis, his partnership interest basis, is now zeroed out.
Okay, that's intricate but logical. Now flip it. What if Gertie's outside basis was more than the partnership's inside basis in the assets? Say, his partnership interest basis was $529,000, way more than the $314,000 inside basis.
Right. Now, the goal is to increase the basis of the received property to soak up that extra outside basis. The steps are parallel, but kind of in reverse for the adjustments.
Oh, so?
Step 1, still the same. Assign basis to all assets equal to the partnership's basis initially. Cash gets $4K, inventory $10K, Lot A $200K, Lot B $100. That's $314K total.
Okay.
Step 2. Now look at the last property category, lots A and B, and find assets that have appreciated fair market value is higher than basis. You increase their basis, but only up to their fair market value.
So Lot B.
Exactly. Lot B appreciated significantly, 100K basis, 300K FMV. We increased its basis by $200,000, bringing it up to its $300K fair market value. Lot A depreciated, so no upward adjustment there in this step.
How much basis increase do we need overall?
Gertie's outside basis is $529K. The partnership's inside basis was $314K, so we need a total increase of $215,000, $529K, $314K. Step 2 just used up $200,000 of that increase on Lot B.
Leaving $15,000 of increase still to allocate.
Correct. Step 3, allocate this remaining increase among all assets in the last property category, Lot A and Lot B. But this time, the allocation is based on their relative fair market values.
Fair market values, Lot A is $150K, Lot B is $300, total $450K.
Right, so Lot A gets an increase of $5,000, which is $450 times 15K. Lot B gets an increase of $10,000. Lot A is $205,000. Its original $200K plus the 5K increase from Step 3. And Lot B is $310,000. Its original $100 plus the $200K from Step 2 plus the $10 from Step 3.
Let's check the total. $4K plus $10 plus $205K plus $310K.
Comes out to $529,000. Again, exactly Gertie's outside basis, zeroed out.
It really forces that number to zero, doesn't it?
It absolutely has to. That's a key distinction. You mentioned a pass key earlier. In a non-liquidating distribution, like a regular withdrawal during the year, the basis of property received can't go below zero, but the partner still has basis left. In a liquidating distribution, the partner's basis account must go to zero.
Why is that zero-out rule so critical?
It ensures all the tax history, all the bases associated with that partnership interest is fully accounted for when the partner leaves completely. There are no lingering tax attributes left hanging, which maintains the integrity of the system.
Okay, so all these detailed, sometimes complex calculations are hitting the partner. What about the partnership itself? Does it recognize gain or loss when it just distributes these assets?
Generally, the partnership itself does not recognize gain or loss just from distributing assets in liquidation, because it's a flow-through entity. Its income, losses, gains, deductions, they all pass through directly to the partners. Any gain or loss the partnership might realize from, say, selling assets to get cash for the distribution or any liquidation expenses it pays, those items flow through to the partners and get factored into their individual bases before the final distribution calculation happens.
So the entity stays tax neutral on the distribution itself.
Okay.
That covers withdrawal. But that's not the only way out. Another common path is simply selling your partnership interest to someone else, right?
Absolutely. Selling your interest to a new partner or an existing partner, it has its own set of rules.
And generally, how is that treated?
As a general rule, when you sell your partnership interest, you recognize a capital gain or loss.
Why capital?
Because, for tax purposes, your interest in the partnership itself is usually considered a capital asset, like owning stock.
Okay. And how do you figure out the amount of that gain or loss?
Pretty standard calculation.
Yeah.
It's the amount realized from the sale minus your adjusted basis in the partnership interest just before the sale.
Amount realized. Is that just the cash you get?
Not quite. Here's a really critical point that catches people. The amount realized includes not just the cash and property received, but also any share of partnership liabilities that the buyer effectively takes over from you.
Ah, so debt relief counts as proceeds.
Exactly. It's treated as if you received additional cash equal to the debt you're no longer responsible for.
Okay, let's use Christy again. She sells her 20% interest for $15,000 cash. The buyer also assumes her $5,000 share of partnership liabilities. What's her amount realized?
For Christie, the amount realized is $20,000. That's the $15,000 cash plus the $5,000 relief from liabilities. That $20,000 is the starting point for calculating her gain or loss. She'd subtract her adjusted basis from that.
Seems mostly straightforward capital gain or loss. But you mentioned exceptions earlier. Is there something that can turn this capital gain into ordinary income?
Yes, there is. This is really important. While the overall sale is usually capital, any portion of the gain that's attributable to the selling partner's share of those hot assets is carved out and treated as ordinary income.
Hot assets again. Remind me what they include in a sale context.
It's the unrealized receivables in inventory, just like in liquidations, but also includes potential depreciation recapture on the partnership's depreciable assets.
Depreciation recapture. Explain that.
Sure. When a partnership takes depreciation deductions on assets like equipment or buildings, it reduces its taxable income. If it later sells that asset for more than its depreciated value, its adjusted basis, some or all of that gain might be recaptured as ordinary income, essentially reversing the prior tax benefit of the depreciation.
So the hot asset rule prevents turning that potential ordinary income into capital gain just by selling the partnership interest instead of the asset itself.
Precisely. It preserves the character of that income. This can significantly change the tax bill for the selling partner.
What about timing? If a partner sells mid-year, how does the partnership's income or loss for that year get split?
It's allocated pro rata, usually based on the number of days each person was a partner during the partnership's tax year.
Can you give an example?
Sure. Say partner A owns 20%, sells on March 31st. That's 90 days into the year, assuming a calendar year. The partnership earns $80,000 for the whole year.
Okay.
Partner A's share of that income would be roughly 3,945 days. That's $80,000 total income times 20% ownership times 90 days, 365 days.
And the buyer?
The buyer, partner B, would get the rest of that 20% share for the remaining 275 days, which would be about $12,055. It aims for a fair split based on the time each was actually exposed to the partnership's operations.
Makes sense. Okay, that brings us to the third pathway. Retirement or death of a partner. The circumstances are different, obviously, but the financial side still needs sorting out.
Indeed. And the treatment of payments made to a retiring partner or to the successor of a deceased partner often gets split.
Split how?
Payments made in exchange for their interest in the actual partnership assets generally result in capital gain or loss, similar to a sale. However, if the payments is determined based on partnership income, like say a retiring partner gets 10% of the profits for the next 5 years, those payments are usually treated as ordinary income to the recipient.
Treated as ordinary income even though they're leaving.
Yes, it's often treated as either a distributed share of income or a guaranteed payment, essentially as if they were still getting a share of the partnership's earnings. It flows from that core pass-through nature of partnerships.
That could definitely surprise some people. Now, you mentioned something earlier about fairness for incoming partners, a Section 754 election. What's that about?
Yes, the Section 754 election. This is a really important mechanism. Partnerships can choose to make this election when there's a transfer of interest, like a sale, or upon a partner's death.
And what does it do?
Its main purpose is to address a potential mismatch. You see, a new partner buys in or inherits an interest at its current fair market value. That's their outside basis. But the partnership's basis in its underlying assets, the inside basis, might be much lower, reflecting old historical costs.
Right, we saw that difference earlier.
Without a 754 election, if the partnership later sells an appreciated asset, that new partner could get hit with tax on a gain that actually built up before they even joined the partnership, which isn't really fair.
Okay, so 754 fixes that.
It allows for what's called a Section 743B basis adjustment. This adjustment basically equals the difference between the new partner's outside basis, what they paid or inherited it at, and their share of the partnership's inside basis in its assets.
And who gets the benefit of this adjustment?
Critically, this adjustment is allocated only to the new transferee partner. It doesn't affect the partnership's overall income calculation or the other partners. It essentially gives the new partner a special personal inside basis that aligns with their outside basis.
So it levels the playing field for them.
Exactly. It aims to give them the tax consequences as if they had bought their share of the assets directly. Once the partnership makes the 754 election, it usually stays in effect unless revoked with IRS permission. And sometimes, if there's a big built-in loss, over $250,000, this 743B adjustment actually becomes mandatory.
Let's see it in action. Oscar buys Bernice's 25% interest in Hanley Partnership for $500,000. Hanley has made a 754 election. The partnership owns a building with an inside basis of $1,200,000, but it's currently worth $2 million.
Okay, so Oscar paid $500. Okay, that's his outside basis. What's his share of the partnership's inside basis in the building? It's 25%, with $12 million of $200,000.
Ah, so there's a $200,000 difference, $500K, $300.
Precisely. That $200,000 is Oscar's Section 743B adjustment related to that building. It's allocated only to him. So for tax purposes related to that building, it's like Oscar's share of the basis is $500,000. $300K common basis plus $200K adjustment.
What's the consequence? Say the partnership sells the building later for $2 million.
The partnership's overall book gain is $800,000. Two-mirror sale price, $1 two-mirror book basis. But the tax gain is calculated differently for Oscar. The total tax gain recognized by the partnership is still based on the $1 two-mirror inside basis, so $800,000 gain.
$2 million, $2 mem.
How is that $800K gain allocated?
Normally, Oscar's 25% share would be $200,000, but because of his $200,000 basis adjustment, his share of the taxable gain is wiped out. That $200K adjustment offsets his share of the gain. So the other partners would recognize their shares of the gain, but Oscar recognizes zero gain related to the pre-purchase appreciation.
Wow, that's a huge difference for Oscar. It really does seem like a fairness mechanism.
It is. It prevents new partners from paying tax on phantom gains they never economically benefited from.
What a deep dive.
Yeah.
Okay, let's try and pull this all together. We looked at the three main paths out of a partnership: withdrawal, sale, retirement, or death.
Right, and how each has really distinct rules for basis, gain, and loss recognition.
We saw how crucial hot assets are, whether you're withdrawing or selling, in potentially triggering ordinary income instead of capital gain. And those detailed allocation rules, when multiple assets come out in a liquidation especially, that key difference based on whether your outside basis is more or less than the inside basis.
Definitely complex there. And finally, the Section 754 election and that 743B adjustment, a powerful tool to ensure fairness for incoming partners.
Yeah, if you connect it all, it really paints a picture that, in partnerships, there's just no single simple exit button. Every method has these intricate calculations, these tax implications that can really change the bottom line for everyone involved.
Thinking critically is key.
Absolutely essential to navigate it well.
So here's a thought for you, our listeners. The next time you hear about a business partner leaving a venture, think beyond the handshake. Consider the complex dance of numbers and rules likely happening underneath. How are they figuring out basis? Is there a gain, a loss, ordinary income, or capital? And maybe even think about how these rules might shape the strategies partners put in place long before anyone even mentions leaving.
It definitely influences planning.
Absolutely. Thanks for joining us on this deep dive. Until next time, keep exploring.